today is my partner and I are looking at buying our first home, and we're confused about what type of mortgage to take out. Can you give us some guidance? So what I thought I'd do is I'll just go through the different types of mortgages, and then hopefully it'll give you an idea about the things you need to do. The first thing we'll look at is principal and interest versus interest only. So basically principal and interest is actually paying off the loan over the term of the loan. So let's say that you have a loan for 25 years. At the end of that 25-year period, you will have actually paid off all of that loan, and then you'll loan that house outright. As opposed to interest only, which effectively means that the amount of mortgage that you take it out for will still be the same over that long 25-year period, because you're only actually paying the interest. The advantages of the interest only, however, are that the repayments are actually lower because you're not paying off the interest. However, this is a false economy because effectively you owe far more at the end of that term. So you might get some short-term benefits, but the long-term benefits aren't there. And in most cases, if it's your own home, you should always be paying principal interest. And if it's a rental property, then you would consider whether you go interest only. Okay, so the next thing we're going to look at is a fixed mortgage. All this means is that the interest rate is fixed for a set period of time, and typically between 6 months and about 5 years. So what that means is that, let's say that interest rates go up or down in the market, it doesn't actually make any difference to you because you've got your interest rate locked in for that period of time. In New Zealand at the moment, most people have their mortgages on fixed, currently about 85%, and most of those are between 2 to 3 years. And the big advantage of this is the fact that you know how much you're going to be paying every month, and so it's more effective for you to be able to budget with. The downside of fixed mortgages is that they don't have a lot of flexibility, so if you want to change your regular repayments or make lump sums, you're far more limited in what you can do. The next type is a floating mortgage, and all that means is that the interest rate is at a floating amount. So if the interest rates in the market go up, the amount that you repay on your loan also goes up. And conversely, if interest rates go down, then the amount that you pay goes down. So in the last few years, we've had interest rates going from 5.95 up to currently about 10.5% on a floating. That's a huge increase in what you're going to be paying every month. So it's actually been a lot better for you to be able to fix your mortgages because you've known exactly what you have to pay. The next type of mortgages are revolving credit, sometimes called orbit facilities or flexi facilities. They come in a whole range of different names. But really what they are is an overdraft. Now they are the most flexible of mortgages, but they also have the most problems with them. And what I've actually found is in a lot of cases I've suggested to my clients to actually get rid of their revolving credits. Because effectively what happens with revolving credits, and they are a little bit complex, is that what you do is you have an overdraft. So at the beginning of your month, your salary goes in, and let's say you owe $100,000 on your mortgage, and you earn $5,000 a month. So at the beginning of that month, then what happens is that you put your $5,000 onto your $100,000 mortgage, and you're only paying interest on the balance, which is $95,000. Then what you do is you put all of your expenses onto your credit card, and then at the end of the month, what you do is you pay off your credit card out of the revolving credit facility. So all it effectively means is that throughout the month you've actually got your salary sitting in your mortgage account, which means that you pay less interest because you owe less. Again, the downside is that you have to be reasonably disciplined in order to manage a revolving credit facility, and in a significant amount of cases I've actually found that it's actually created more difficulties for people, and over a period of time they haven't actually paid off any of their mortgage. So I guess in summary, revolving credits, they're fantastic facilities because they're very flexible, but the downside is you need to have some discipline in order to manage them. Next thing I'm just going to talk about is the term of the mortgage. Traditionally we've always seen mortgages at a 25-year term, but recently the terms have increased to 30 years. The sole reason for this is that as houses have got more expensive and loans have got much higher, people are struggling to be able to afford the payments on a 25-year term, which is why they've increased them to 30. So again, it's a bit like the principal interest and interest only, is that it does make it easier on the short term in respect that your payments are low on a 30-year term, but it also means that on the downside it's going to take you 30 years to pay off your loan as opposed to 25. The other downside is that the longer you pay interest for, the more you actually pay interest. So going from a 25 to 30-year term may cost you an extra $100,000 in interest over that period of time, depending on the amount that you've actually borrowed. So there's a couple of key things that we've gone through there. The best advice I can give is actually go and talk to your bank manager, your mobile manager at the bank, and a mortgage broker, and actually just sit down and work out based on your own personal circumstances, which is actually the best mortgage for you. Because a lot of people just focus on the best interest rate, which is not necessarily the best mortgage for you.